Retiring early isn't a fantasy. It's a plan you can start today with small, repeatable steps. In this video, I'm not selling a miracle. I'm sharing a practical approach you can actually live with, even if you're starting with little saved. The core idea comes in 3 layers. Fix the leaks in your money habits, and then build a simple core portfolio you can keep for decades. You'll also grow additional income that compounds faster than you expect. First, fix the leaks. Start by tracking every dollar for a full month so you can see exactly where it goes. You'll likely find small, invisible drains that add up to real money. Look for 2 kinds of leaks: recurring subscriptions you forgot you had, and everyday choices you can swap for cheaper options. Cancel unused services, renegotiate a phone plan, cook at home more often, and choose free or cheap entertainment when possible. Next, automate the basics so the plan isn't dependent on willpower. Set up automatic transfers that send money to savings and to retirement accounts the moment you're paid. Let the money move before you see it, so you're not tempted to spend it first. Make sure you get the employer match on your 401k or equivalent plan. If your employer matches 3% to 6%, contribute enough to capture that free money before you do anything else. Then open an individual retirement account or a Roth with low-cost funds to fill the gap. Keep the core portfolio simple and cheap. A basic mix around 60% in a broad total stock market fund and 40% in a broad bond fund is a solid starting point for long horizons. Rebalance once a year so winners don't take over, and avoid chasing hot funds or fancy strategies. For most people, that core portfolio will ride out storms and still grow over time. The key is consistency, small contributions, minimal fees, and a boringly steady course. As you automate and invest, you should also build a growth engine outside the market. Side projects or a part-time business can turn 5 hours a week into real returns over years. Think of skills you have that people would pay for and that scale with demand. Use the profits from that side income to accelerate your retirement plan. Reinvest the extra earnings into tax-advantaged accounts when possible, so your growth compounds in the right places. Treat these earnings as a turbocharger, not a vacation fund. Tax strategy matters even when you're focused on early retirement. If your income is low enough, a Roth account can be worth more than a traditional one because you won't pay taxes on growth. If you're above the Roth threshold, consider traditional accounts to reduce current taxes and still save a lot. If you're a high earner, look into a backdoor Roth so you can get tax-free growth without the income limits. A health savings account is another powerful tool if you have a high deductible plan, because it can be used for future healthcare costs and still grow with tax benefits. Learning how to use tax-advantaged accounts effectively is part of the plan, but so is keeping costs low. Fees eat away at returns, especially over long periods, so choose funds with low expense ratios and avoid unnecessary trading. The math is simple. Lower fees mean more of your money stays invested. The withdrawal phase deserves its own careful plan, even if it feels far away. A practical approach is a bucket system. Keep cash for 2 years in a safe place to weather market dips. This avoids selling in a down market just to cover everyday needs. Beyond the cash bucket, use a bond-like layer to cover next 3 to 5 years of needs. The rest of the money can stay invested in stocks for growth, with a plan to adjust as you get closer to your target retirement age. This setup reduces sequence of returns risk and makes your withdrawals more predictable. A simple starting rule for withdrawals is to aim around 3.0% to 3.5% of your portfolio per year, adjusted for inflation and personal circumstances. If you have a larger cushion or want more safety, you can go a bit lower. If your plan has more flexibility, you might creep toward 4%. The exact number isn't magic, but the idea is to keep yourself insulated from big market swings. Regular reviews are essential, even when the plan feels boring. Do a quarterly check-in to confirm your automatic contributions are working and your balances are on track. Rebalance annually so your original risk posture remains intact. The biggest mistakes people make are chasing new trends, letting debt creep up, and assuming the plan will look the same in 20 years. Stay away from expensive products, and don't try to time the market. The goal is to stay the course when others panic. Let's bring this to life with a simple example. Imagine you earn $90,000 a year and you start saving 25% of your gross income. You capture the full employer match and invest in a 60-40 core portfolio. Over 25 years, with steady contributions and reinvested dividends, you'd likely accumulate well over $1 million, assuming modest market growth and no major interruptions. If you start at 25 and keep that pace, You could reach financial independence roughly in your early to mid-50s, depending on your location, healthcare costs, and lifestyle choices. The bigger takeaway is that the earlier you start, the more you borrow from the power of compounding across decades. Small steps multiply into big outcomes when you stay consistent. Early retirement isn't about chasing a single magical fund. It's about building a plan you can live with year after year, even as life changes. The plan has to survive job changes, market dips, and family responsibilities. The boring parts often decide the outcome, so don't skip them. A note on flexibility can help you sleep at night. You don't have to retire exactly at a certain date to be financially free. If you reach your income goal before a calendar date, you can scale back or transition to part-time work that you enjoy instead of quitting suddenly. If you're worried about debt, tackle high-interest loans first. Paying down debt that costs more than the market earns is a guaranteed way to improve your financial trajectory. Refinance or consolidate where it makes sense to lower the total cost of debt. Your plan should also acknowledge real-life costs. Healthcare, housing, and inflation can erode what you save unless you plan for them. Build a buffer in your emergency fund and review your long-term assumptions at least once a year. The practical nature of this approach is what makes it non-cringe and sustainable. You're not chasing perfection, you're choosing progress, 1 month at a time. The numbers may vary, but the discipline remains the same. Save early, keep costs low, and invest in a simple, durable way. If you want to tailor this to your situation, start with one small change this month. Pick one subscription to cut, automate one savings transfer, or set up your employer match correct to the last cent. Small wins add up to big shifts over time. One more thing to consider is real estate or a small side business as an additional income stream. You don't need to own a large property to create passive-ish income. A modest rental or a digital product that scales with demand can become a meaningful pillar in your plan. Think of retirement as a long, steady journey rather than a sudden exit from work. If you treat it as an evolving goal, you'll be far more likely to stay on track. Your future self will thank you for the patience you showed today. If you're listening and thinking, this still feels complex, you're not alone. The simplest version is this: spend less than you earn, invest the difference in a low-cost, diversified core, and keep growing your income so you can invest even more. It sounds basic because it is, but it works when you do it consistently. Now imagine sharing this with someone else. If a friend, a family member, or a colleague asks how to get started, you'll have a straightforward roadmap to point them toward. The point isn't to be perfect, but to be reliable and boringly effective. If you found this helpful, remember that a real plan starts with one small step. If you want more details, or you want me to tailor a plan to your income and goals, tell me in the comments. I'll respond with practical actions you can take in the next 30 days. Like this video if you found the approach clear. Subscribe for more grounded, real-world strategies that help you build wealth without the hype. And leave a comment with your situation or a question you'd like me to cover in the next video.